Intel is one big player, but I want to understand how you're thinking about the space coming off of a really busy week that got rattled by tariffs and other announcements, the Chip and Science Act as another. How are you thinking about the space and the catalyst going forward?
Hi, thanks for having me. I think over the longer term, AI would remain a very relevant theme and a very key driver for the semiconductors industry and the whole ecosystem. So on that, we're still very confident on the secular outlook. There's still plenty of support for that. But unfortunately, we're in a very complex and uncertain macroeconomic landscape at the moment, where companies with the most complex supply chains are likely to be at risk, and that is including the semiconductor sector. So unfortunately, given the macro backdrop, these stocks are not doing well at the moment. But I think that valuations have become more attractive for the sector as a whole. And I do believe that if you pick the leaders across the semiconductor ecosystem, you are likely to still do pretty well over the longer term.
Is Intel a leader? I don't know whether it's an individual name perspective, but would you put that company alongside some of the winning formulas that we've seen of late with the NVIDIAs at the top of the list?
So for now, probably not. We have to await more strategic direction from the new CEO. I think Intel faces a bunch of challenges, regardless of who is in charge. Basically, on the design front, is lagging competitors like NVIDIA and AMD, and as a foundry business, is also its direction is not clear, and they really have to revive that foundry business in order to secure its position in the sector. So I guess we'll just have to wait and see. Apparently, the market is very enthusiastic about the new CEO.
Jenna, let's talk about software for a moment, because we had a guest earlier this morning kind of tell us that these software names are a little bit more insulated from a lot of the tariff woes that we're seeing other names really get battered by. Would you agree with that? How much more of that protection do some of those names get?
Yeah, I would tend to agree with that. I think in terms of the supply chain impact, I think obviously the hardware, the industrial sector would be more badly hit, whereas the software, it would be fundamentally less hit. So I would agree on that point. But obviously, given the various macro uncertainties that we have, ultimately, a lot of these software companies, I mean, if you look at the mega cap tech companies, they're still heavily exposed to the domestic U.S. economy in terms of, say, advertising, cloud revenues, etc. Ultimately, it's still dependent on the business cycle. I mean, arguably less cyclical, less sensitive, but it's still dependent. And obviously, the valuations have come off because of the sentiment hit. So I guess in the near term, I think it is best to stay cautious because we still have potentially a range of uncertainty coming from the reciprocal tariff front that is going to hit the sentiment channel.
The reason I'm curious is because more recession fears have started to come to the fore. And when we think about the tech sector, we don't really remember the fact that all of these software names, many of them, I'm thinking like the social media companies, are sensitive to that digital advertising. How much of that is vulnerable to the swings in the economy? Could there be more vulnerability there going forward if these recession fears do play out?
Yes, I think there's certainly some risk because what we are saying now is basically the hit by the sentiment channel. We haven't really actually seen too much of the hit to actual earnings and the real economy. I mean, there is recession anxiety, but I wouldn't still put that as a central case. But if that eventually did play out, I think there could be more to go in terms of the hit to the earnings outlook. So that would be quite bad to these companies because advertising, I think, is very cyclical. They're probably the first to be cut if a company wants to reduce its spending. And if consumer confidence is falling, then consumers are going to tighten their belt and spend less. That's all going to hit all these companies eventually. But I think, as I said, it's currently still the sentiment that is playing out there is not really real hits to the earnings yet. We just have to wait and see.
And what about overseas? Because some of the woes here in the United States might be a gain for, let's say, Chinese stocks. It seems like every time a new model comes out of China, it sends U.S. tech stocks really freaking out, especially those with exposure to AI. How are you thinking about positioning outside of the U.S.?
Yeah, I think there's certainly more enthusiasm on Chinese tech stocks. I think mainly it's because sentiment has been way too depressed, and basically a lot of overseas investors have written off Chinese tech for a while, and there's suddenly a bunch of good news, including some shift in the tone from the politicians, a bit more welcoming tone, a bit more supportive to the private sector. And of course, the innovation in AI and broadening out of using AI in the various sectors in China. So I would say in the near term, I think it's reasonable to feel more optimistic. I think there could still be more inflows going into that sector. But I think we have to be a bit more cautious because we understand Chinese stock market is very volatile and a lot of retail participation. I don't think this time would change. I think there would be still a lot of volatility and profit-taking activity if the index continues to go up from here. So I think we've got to be a bit more careful from here.
It seems like forever ago that the market was freaking out about DeepSeek, and all of a sudden, with some earnings that have come out, CapEx has been reaffirmed. Investors seem assured that maybe we're a little bit past this. Do you still see the DeepSeek fears showing up anywhere, if that's something that's going to drive the market going forward?
Yeah, the thing is that I think fundamentally we are of the view that DeepSeek's appearance, it shows that these models can be run in a more efficient way and thereby lowering the cost of running it and training, and thereby eventually it would stimulate demand if the cost goes down. So more people would be using it. So ultimately that's going to be beneficial for the whole sector. But at the same time, the thing is, we don't know yet. And if you look at the latest earnings results from, say, NVIDIA, you won't be able to see that impact yet, actually. It's more distant in the future whether the hyperscalers are going to reduce their capital spending because of the more efficient model. So there's a lot of questions that are yet to be answered. But I think from our view, if you look back at history of the semiconductors, of how cost impact demand, usually when costs are lowered, then eventually demand actually grows exponentially. But of course, you have to also consider that the pie is going to be shared by potentially more players. So I think just focusing on, say, one or two particular leaders is potentially more risky. That's why our strategy is always to get exposure to a whole range of the stocks in the semiconductor ecosystem.